In today's show, we're opening up the listener mailbag, and we're going to answer questions about pension selections, questions about the challenges you could face if there's an age gap between you and your spouse, and then discuss the hidden costs that you might not be seeing when you're just looking at your retirement income from a surface level. Hey, there's a lot of great thoughts, recommendations, and strategies that we're going to discuss in today's show that you could potentially utilize in your situation.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome into the Retirement Show, all about your life, your money, and well, today, the last episode of the month, we're going to be talking about your questions. We open up the listener mailbag. I'm your host, Scott Searins. My goal is to help you thrive in life, wealth, and retirement. And I just wanted to stop and pause here and just tell you thank you. So if you've been listening to our podcast, I wanted to tell you thank you for listening. I hope that we're bringing you value and benefit when it comes to all those subjects, when it comes to your life, when it comes to building wealth, when it comes to helping you be confident for retirement. So thanks for listening. Thanks for joining in each week, and we hope that we're bringing you some value and benefit. And I'll tell you what, if you're enjoying this content on the podcast, another location to check us out is on our YouTube channel. You can go to YouTube and put in Searins Financial Group. That's Searens, Searins Financial Group. Some of our recent videos out there on YouTube were all about the retirement tax surprise. We've got 3 cases in which you may want to claim your Social Security at age 67 versus age 70, and then how to get more tax-free money for retirement. So those are some of the latest videos that we have got out there on YouTube, plus many, many more in regards to retirement and in regards to building wealth. Hey, as I had mentioned, today we're opening up the listener mailbag to answer questions from people just like you. You know, I like this because it takes all of the strategies and the tactics and all of the rules of thumb and everything that we're talking about and just kind of now puts it into real life, puts it into somebody's shoes that's listening to the show going, hey, here's my life situation. I get it. I understand all of the things that you talk about, but here's actually what's going on in my life. And so based on all of those things, what's the recommendations? How would you take a look at my specific situation? So listen in, because there's a lot of questions that might apply to you. There's questions where the answers, the responses, the strategies, the thoughts that we're going to talk about, those could apply to you as well. We've got questions in regards to pension selections. Pensions are a big deal, right? This is a big decision you have to make, and typically there's no going back once you make the decision on a pension. And so we're going to walk through, first off, what it is, what the different decisions involve, and what that means when you're making that pension selection. Then we've got a question in regards to challenges if there's an age gap between spouses. So some of the challenges that spouses might face when there's an age difference, right? Maybe there's a 4-year age difference, or a 5, or a 8, or a 10-year age difference. What are some of the challenges that might come up? So we've got a question that came in about that. And then the last question that came in said, hey, what if my IRAs, 401ks, what if my pensions and my Social Securities cover everything from an expense standpoint? Then what about my IRAs and 401ks? What should I do with those? And my thing that you'll see when we talk about this question is, do the pensions and Social Securities really cover everything? We're going to talk about some of those hidden costs to see if this person's really thinking through them. So that's what we're going to talk about today. And hey, without further ado, let's just dive right into the first question, which comes from Jack. So Jack says, my pension doesn't provide an inflation raise each year, so I'll still be getting the same amount at age 85 that I'll have at 65. Should I even bother taking the spousal continuation option for my wife to keep getting the monthly payment if she outlives me? So Jack, again, I'm just going to kind of repeat this here. It's a longer question. My pension doesn't provide an inflation raise each year, so I'll get the same amount at age 85 that I'd get at age 65. Should I bother taking the spousal continuation option for my wife so that way she would get paid if she were to outlive him? Lots going on in this question. So let's really break this one down into some parts here for Jack and for anybody else listening that might have a pension that they need to make a decision on sometime soon here. So let's break this down. First off, a pension is a guaranteed stream of income, where if you elect to take a pension, you're going to get a guaranteed stream of income, meaning they're going to send a check to your mailbox, well, actually to your bank account, right? They're going to send that check to your bank account each and every month, month after month after month after month, until you pass away or until your spouse passes away. And we'll talk about that in a second here, but just so we understand, a pension's a guaranteed stream of income. The first thing that Jack brings up here in his question is he says, hey, there's no inflation raise. Well, what does Jack mean by that? Well, what he means is that a pension, the amount that he will get each and every month, month after month after month, his is going to stay flat. Now, some pensions, for instance, work with some teachers. Some pensions do have a cost of living adjustment. Not all pensions do. A lot of pensions, not necessarily for teachers here in Illinois, but a lot of pensions just offered by companies, businesses, a lot of those pensions stay flat, just like Jack's here. What does that mean? Well, example, if Jack elects to get his pension and he starts off today getting $1,500 a month. Well, what Jack will get is $1,500 a month this year, $1,500 a month next year, and at age 85, just like Jack mentioned, he's going to still get $1,500 a month, meaning there's no inflation raise. Now, so if you think about it, the cost of goods, the cost of services, the cost of gas, the cost of your groceries, everything continues to go up over time. That's called inflation. And just to kind of give a thought here to help in regards to, helping you understand what Jack's talking about, I went to usinflationcalculator.com and I said, hey, what if 15 years ago, Jack were to have this, in my example, right? I kept just talking about $1,500. So what if in 2008, 15 years ago, Jack were to purchase an item for $1,500? Well, according to usinflationcalculator.com, that $1,500 purchase that he made 15 years ago, now here in 2023, he'd need $2,129.73. So that's Jack's point, right? Is his pension's going to stay the same, but the cost of goods and services and things that he's going to need to purchase are going to go up over time. $1,500 15 years ago, that's $2,129 today. So that's Jack's kind of first question is, hey, the cost of goods and services are going to go up. I'm going to be taking this flat pension. Should I be taking the highest amount listed on my statement, the lowest amount listed on my statement? Which amount should I be taking that's on that pension statement when I go to elect it? Because this is a decision that he's going to make for life. Well, the reason why there's different decisions on his pension statement are what they call spousal benefits. So Jack called it spousal continuation. I like to call it spousal benefits. What does that mean? Well, let's just say, and in Jack's case here, he said, should I elect for no spousal benefit? Meaning, should I just take no spousal benefit? Meaning, when Jack passes away, his pension stops. There's no benefit that goes to his spouse. That's one thing to look at. Typically, that's going to be the highest payout. So now we'll connect all the dots, right? Jack's saying, hey, inflation's going to go up over time. Do I take this highest payout? But then if I do, and I pass away, there's nothing going to be left for my spouse. And the reason why that's typically the highest payout is because now they're only having to pay for one life. They're just paying out this pension for Jack's life, and in this situation, he passes away, the pension stops. Now, the other options that you might typically see on a pension statement for making your elections, one of the options is what they call 100% spousal benefit. Well, what does that mean? Well, what that means is that if now Jack passes away, they're going to continue to pay the exact same benefit through his spouse's life. You might say, well, that's a no-brainer. I'll just take that one, right? Is it going to be the same amount? Actually, no. Now the pension company is taking on that risk that they're going to have to pay for, the length of 2 lives. So usually this will be less than if they were to just pay for 1 life, meaning no spousal benefit. Then you might see some other things on there as well. There could be a 50% spousal benefit. There could be a 75% spousal benefit. Just to give you an example of what that means, let's just say the 50% spousal benefit, just random example here. Let's say that's $1,000 a month. Jack passes away. Now his spouse gets $500 a month for the rest of the spouse's life and until they pass away. So some things to consider, right? And usually, again, if you're going to add the spousal benefit, it's going to be the payout's going to be less than if there was no spousal benefit. All right, so to help Jack, right, as he goes down the line here of making his decision, some of the factors to consider. One, just like you talked about, inflation. Yes, the cost of goods and services are going to go up over time. So my question to you then, Jack, is do you guys have some investments outside of your pension? If you've got investments outside of your pension, those could help you pay for those costs of goods and services as they go up over time. You want to have maybe those more growth-oriented. Another factor here, Jack, to think about is Social Security. Social Security survivor benefits. Now, if and when one of you pass away, you only get to keep one of the 2 Social Security amounts. Now, that there then means there's already going to be a cut right there to your income. So now if you're cutting income and you didn't choose a spousal benefit on your pension, would the remaining spouse still be able to survive then on half one of the Social Securities and the investments? And that's where you got to start doing some planning around that. And then another factor to consider here, Jack, is that women tend to live longer than men. So if your wife does outlive you, maybe you pass away at the same time, but what if she outlives you for 5 years or outlives you for 10 years? How much stress and strain would it put on her not to have this pension coming in? Which goes back to the first one. What do you have in investments? What's your Social Security look like? And so I think what you really need to do here, Jack, is look at all of the different options, all of the different sources of income that you'll have coming in. We call this an income plan. You really need to put together an income plan and then stress test it to see what happens if one person were to pass away. So, Jack, I know I kind of went through a whole lot there to answer your question, but hopefully I'm answering some other questions that people might have in regards to pensions as well, and then those factors that you want to consider. I guess just a very high level, in my opinion, it is always kind of risky, I'll say, to take the pension without a spousal benefit. Now, if things were reversed and it was your wife that was getting the pension, maybe not as risky, right? Because women live longer than men. But still kind of risky, right? Because if something happens to that person, that pension could go away. And so I guess maybe put yourself in the other person's shoes, Jack, and just say, okay, hey, if someone cut your income down by the amount of the pension, they cut your income down by the amount of the pension, plus they cut your income down by the amount of the Social Security that will be going away, would you be okay? And so that might help you kind of look at it too in a different light. And like I said, I think the main part here is putting together an income plan where you're going to factor in Social Security, factor in your pension, factor in your investments, and find what will be best for you over time from an inflation standpoint, from a living standpoint, and a stress test standpoint if one person were to pass away. Okay. Spent a lot of time on Jack's question, but there was a lot going on in there, and hopefully the other people found that to be of help as well. Our second question today comes from Tess. Tess says, my husband is 11 years older than me, and I probably have better genes than he does, so it seems likely that I'll be a widow for a significant portion of my retirement years. What sort of financial planning challenges does this create for me? Well, Tess, first off, great job in just recognizing that you might have some challenges here. And as we just talked about in Jack's question, right? Females typically live longer than males, plus you have an 11-year difference. So what should we be looking at here? Well, I want to break this down. You actually probably have 4 different challenges here, Tess. We've got an income challenge. You might have an investment challenge, a potential tax challenge, and a health challenge as well. And so I'm going to go into each of those different points just to talk about some different things that you want to think about. As you had said, what are the challenges? And these are challenges that I'm going to bring up so that way you can think about them, plan for them, have, like I talked with Jack there, have that stress test put together to make sure everything will still work for your situation. So let's start from an income standpoint. Guessing, and I can keep this one a little bit shorter here. If you were listening in when I was talking to Jack there, what happens when one spouse passes away? Well, Jack was asking about pensions, survivor benefits. If one spouse passes away and that other spouse has a pension, are there any survivor benefits? Will your income be cut in half? Will your income be cut by 75%? Will your income go away? Will that pension income stay the same? So that's one challenge that you want to take a look at. The other, and the more common challenge here from an income standpoint, is have you thought about Social Security? Meaning, when one spouse passes away, the survivor benefit for Social Security is that the remainder spouse gets to keep one of the 2 Social Securities. They don't keep both. So right there, really quickly, people's guaranteed income stream can get quickly cut in half. So think about that, right? That's the income standpoint that you want to think about. And do you have the means to replace those income streams that are going away? Do you have the means from an investment standpoint? So those are the next challenges. Do you have enough to fill the gap if your spouse were to pass? Meaning, do you have those means, right? So you're going to lose half that Social Security. Do you have enough investments to fill the gap? The other thing that you really want to think about, this isn't necessarily a challenge, but I will challenge you to think about, is in your investments, your spouse is 11 years older than you. You think that, you've got great genes. You could be a widow for a longer portion than that. So let's just say their retirement's already 20 years long. Well, then yours could be 30 years long. Yours could be 40 years long if you're retiring at the same time. I mean, there's a whole lot of different scenarios here. So one thing I really want to stress to you is I believe, my opinion, is that you really need to have a more growth-oriented portfolio. You need to have some equities there so that way you're keeping up with inflation. That way you're keeping your bucket growing. That way, over time, your bucket will grow. It'll keep up with inflation. It'll help give you money to last as long as you plan to live. I find all too often people go into retirement and they get too conservative. For example, I just had a conversation last night with a new couple who came in to talk about their retirement. And as we talked about investments, their investments and investing, one of the things they said is, we're getting really close. We probably should, I think now we have to go pretty conservative, don't we? And it's just a mindset thing that we feel like we need to get conservative as we go into retirement. Don't get me wrong. We need to start shifting our investments so we have enough in our war chest to get us through potential recession, get us through a potential decline in the market. But sometimes I find people can go too conservative. And if you go too safe, your money is not going to be growing enough to last as long as you might need it to last. Or be careful, you might have to cut your lifestyle in the future. Okay, challenge number 3 that you may face here, Tess, is from a tax standpoint. You see, when you're getting taxed as a single, most likely it is at a higher rate than as a couple. You see a single making the same amount of income as a couple, that single is getting taxed at a higher rate. So if, you plan to live the same lifestyle, that means you're probably going to have to take more money out of your investments. You're going to have the same amount of income coming in. Most likely you might have some more money than going out in taxes because single versus married filing jointly, you're most likely there at a higher rate. What can you do now to help prevent that? Well, something that you can look at while the 2 of you are alive, when you're at the the married filing jointly tax bracket is you can look at doing Roth conversions. Does that make sense for you? Does it make sense to get some money out of your IRA and 401k bucket, pay that tax now, pay that tax together, and then you got that money now in your tax-free bucket where it grows tax-free and you can make withdrawals tax-free. So thinking in advance, I would take and put together a tax projection and a tax plan in regards to your scenario. The last challenge that you might face, Tess, is long-term care. Does your spouse have a long-term care protection policy? This is a tough one. I know nobody wants to think about this. Nobody wants to think that they're going to need home health care, or that they're going to need to be in an assisted living facility, or that they're going to go into a nursing home. But you know, Tess, it's reality. It happens. And when it does happen, it can get really costly, really expensive. For instance, I've got a couple I work with that they made the decision not to get long-term care. And guess what? Now the first spouse needs long-term care support. They need home health care support. And there's somebody coming into their house each and every day at thousands and thousands of dollars a month. And I'm just watching their account values drop because of these big withdrawals that they have to take out for this long-term care. So if you're planning to live, if he's 11 years older than you are already and you plan to live, beyond that, right, beyond when he passes away, one thing to think about is long-term care, because if you don't do anything about it and your spouse needs long-term care protection, say they end up in a nursing home at $90,000 a year, how quickly could that deplete everything that you own, leaving you then with little to nothing to live your lifestyle on? So really think about that part as well, long-term care. I mean, Tess, if the two of you haven't yet, what you really need to do is just put together a retirement plan that covers all of these areas: your income, your taxes, your investments, your long-term care, and really stress test it for all of the different scenarios to make sure that money's going to last as long as you will. So Tess, hopefully that helped you out, made you probably really think about a whole lot of things here in regards to the challenges that you might face. But great job on asking that question, because a lot of times people think, oh, that'll never happen in our situation. We're just going to live to the exact same day and pass away, and it's all going to be fine if that happens. But reality is, it doesn't typically happen. A lot of people haven't thought about how the one spouse will survive, how the one spouse will continue to maintain their lifestyle if the other spouse passes away. So hats off to you for being proactive and thinking in advance. All right, our final question for the day. Here it comes in from Bo. Hey, I actually had I have a high school friend named Bo, so very cool. I don't think he sent this in, though, because I know his email address. But here we go, our last question from Bo. Bo says, I need about $5,000 to live on each and every month in retirement. My Social Security and my pension will total about $5,300. Does this mean I'll be able to leave my entire 401k behind to my son? Well, Bo, really good question. And I bet on a surface level, right, on that surface level, it looks like everything's going to turn out great. Yeah, you've got $5,300 coming in. You need $5,000 to live your lifestyle. Hey, from the surface, looks like everything is covered. However, you might be forgetting about a few things. Maybe not. Maybe you already have this into your $5,000, but just in case, let's walk through these so that way other people listening too can really think about some of those hidden costs that we don't always think about when we just add up the numbers from a surface level. So the first thing, Bo, wondering if you've factored in taxes. You mentioned having a pension coming in. Based on your pension coming in, you'll most likely be making over the amount where now your Social Security will become taxable. Most likely your pension is taxable. So was that $5,300 after taxes, or was that $5,300 before taxes? And if it's before taxes, well, you're going to have to factor in some taxes there. And then how about in retirement? You're also going to have Medicare. There's some base Medicare that you have to pay for. And then what if you decide to add on a Medicare supplement or Medicare Advantage plan? Then you might have some premiums from that standpoint as well. And then what about inflation, Bo? Have you thought about that? So while you might say, okay, I only need $5,000 to live my lifestyle today, and you've got $5,300 coming in, let's go back to Jack's question that he had. Is your pension flat, or does your pension have that cost of living adjustment to it? If your pension's flat, I guess your Social Security will have your cost of living adjustment, but will that keep up with the inflation on the $5,000 a month that you need? And then the other thing, which we just talked about with Tess here and her question, is what about healthcare needs? What if you need long-term care in the future? What if you need to go to the doctor? What if something happens? Have you factored in that to your $5,000 a month? So while it's very close here, Bo, it appears that you still need to go to your retirement savings, your 401k or 403b or your IRA or your Roth or your brokerage account, probably to take out some money to live your lifestyle and to maintain your lifestyle. So will you be able to leave your entire 401k behind to your son? Not necessarily. Most likely you're going to have to withdraw some money just to keep up with some of those factors that I had mentioned. The other reason, actually, you could just stop right there and just be like, oh, yeah, I guess I'm not going to be able to. But let's just say, Bo, you had actually factored all of those things in and you're like, Scott, thanks for bringing up those points, but you know what? I already factored them in. So can I just leave my entire 401k to my son? Well, not necessarily on that either, because guess what, Bo? In your 70s, so depending on when you were born, it's going to be either age 73 or age 75, you're going to have to start taking those required minimum distributions, the forced income that you're going to have to take out of your 401k account. Now, you might say, well, but I don't need it. I've already got everything covered. You're still going to have to take the money out of the account. Since you mentioned it's a 401k, you haven't paid any tax on that money yet. So when the money comes out of the account, you're going to have to pay income tax on it. So your son's not going to get all of that 401k. Now, if you take the money out, you pay the income tax on it, you're like, wait, now what do I do with it? I still don't need it. Well, you can reinvest it for your son. You can put it into a brokerage account, which is a non-retirement investment account, or I guess do whatever you want to do with it. The other thing to factor in is that then, let's just say you do pass away, you still have that 401k left. As long as your son's listed as the beneficiary, yes, it'll go to him, but just know they came out with a 10-year rule where your son will have to withdraw that money over 10 years. He'll be paying income tax on it too. So one thing I would kind of look at, it seems like it's really important to you, Bo, to get this money over to your son. I would look at what I'd call as like family tax bracket management. Where are you? What tax bracket are you in? Where's your son? What tax bracket is he in? And if he's in a higher tax bracket than you and you just leave all of this to him and then he's got to take it out over 10 years, guess what? He's going to be paying more taxes on that money than you would have. So that's where you look at kind of things from a family standpoint and say, hey, should we start potentially doing Roth conversions, paying tax today, getting it into that tax-free bucket? You do that, now you're passing on a tax-free bucket to your son. The Roth, he still has the 10-year rule, but all of that money comes out to him tax-free. Bo, great question. A lot of great points we could cover through your question there. Maybe you've already thought of all those things. A lot of times people haven't. So when we put together their income plan, we're making sure we're factoring in Medicare, we're factoring in the taxes, we're factoring in everything. So at the end of the day, they say, here's how much you got coming in, and we're going to help them maximize what they can spend, but already factoring all those other things in. So at the end of the day, they understand what they can spend on their lifestyle needs. Hey, thank you for all of the questions. Now, if you want to submit a question to get answered on the air, you can go to lifemoneyshow.com, click on this episode, click on the show notes for this episode. You'll see a box on the right-hand side there where you can submit your question. Also, as I mentioned earlier, go to YouTube, subscribe to our YouTube channel. It's Sieren's Financial Group. Or if you go to lifemoneyshow.com, we've got plenty of links there over to our YouTube channel. We've had great videos. Some of our most recent videos is about how to create more tax-free money in retirement, whether you should take Social Security at age 67 or 70, in 3 cases, why you might want to take it at 67. And we've also had videos in regards to the retirement tax surprise. So lifemoneyshow.com, click on the YouTube link. That'll take you right over to our YouTube channel, and you can subscribe there as well. So Last little notice, don't forget to subscribe on your favorite podcast player as we're coming out with new podcasts, new episodes each and every week to help you in life, wealth, and retirement. I look forward to our next conversation helping you enjoy life today while being financially confident about your retirement.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.